Welcome back, members. I request CA Gita AB ma'am, Vice Chairperson of SIRC, to escort Gururaj Acharya sir onto the dais and welcome him with a floral bouquet. Thank you. Come, sir. Thank you, ma'am. Gururaj Acharya sir hails from the temple town of Udupi. He is born and brought up in the iron city of Bellary and is now settled in the knowledge city of Bangalore. He qualified CA after completing articleship under Guru Prasad and Co. Bellary. He is presently the senior partner of KG Acharya & Co. Chartered Accountants, specializing in corporate finance, corporate taxes, and company law. He is an All India ranker in CA, Inter, Final, ICWA, Inter, and Final. He is a director on the board of directors of Karnataka Bank, was a director on the board of directors of State Bank of Mysore, was a member of the Karnataka State Level Audit Advisory Board, was a co-opted member of the Expert Advisory Committee and Committee on Accounting Standard for Local Bodies by ICI New Delhi. Was a member of Bangalore Financial Reporting and Review Group formulated under the FRRB of ICI New Delhi. He has authored a book titled Internal Financial Control, Practical Handbook on Audit Report on What Can Go Wrong, published by KSCA. He is a resource person on accounting standards, Companies Act, corporate finance, and corporate tax. I welcome you, sir, and the dais is to you, sir.
Thanks, sir. Thanks, Johnson, for the introduction. Thanks to the Vice Chairman of SIRC for taking me away to the stage. Let me tell you that this stage has not been new to me. I was here 10 years ago for several occasions to talk on Companies Act and what a journey it has been. That's why it's always said, I have my guru in the Companies Act, Mr. Manor Gupta here. Sir, what is more important in a trip? Is it the journey or the destination? Which is more important, journey or the destination? They say it is the company which is most important. It is the company which is more important. And in this journey of mine, I had the company of the Companies Act itself. Look at the pun there. What an amazing journey it has been. I have been, I was very happy to say that this act is younger than me. Because 1956 Act was senior to me. So therefore, whenever a new act comes, it's always a challenge for actually, in a way, as students, whatever you have read, you will be very familiar with that. Any new act, generally, you feel foreign to that act. But then the best way to familiarize yourself with the act is to talk on the subject. So, and that's where my popular quote comes. It was not when I was taught, but when I was teaching that I learned a lot. So thanks to the people who provided me the stage, Mr. Pramod, the Vice Chairman, is here, in absentia Divya, the Chairman. I should acknowledge them for inviting me here and again asking me to refresh my knowledge in the Companies Act. Our journey of the last 10 years has been happening incrementally. What I mean by incrementally is, of course, we read the Act, then there were amendments, then there were notifications, circulars. But this topic, I saw it first, somebody's coining this name, and I felt I should talk on this particular topic, not for making you learn, but for myself gaining value add on a total scale. Now you will see that in the next 27 slides, you will probably have a refresher course on Companies Act. Okay? Having said that, Let me also tell that it was during the secretaryship of period of Mr. Allama Prabhu that we had series of sessions on Companies Act those days in 2013. Let me tell you, sir, what is the birthday of Companies Act, What is the birthday? When was Companies Act born? Srinivas is also here. We had done several programs on Companies Act during your term. What is the birthday of Companies Act? I mean, if you see section 1, it says the day it gets notified. When was it gazetted? So, naturally 10 years ago. I and Companies Act, like Julius Caesar says, I and Danger were born on the same day. He the younger, I the elder. That's a very popular statement of Julius Caesar. So I should say that probably I and Companies Act were born in the same month of August. He the younger and I the older again, because I was born on August of 6th and this was born on August of 30th. 30th August 2013 was the birthday of Companies Act. Completed 10 years. And how does it look? Companies Act 2013, a much leaner act. We were talking about leaner and putting on weight. So much leaner act. Is it leaner? Is it leaner? In comparison to 1956 Act, 2013 Act looks leaner. We will see whether it is actually leaner. Investor protection against major corporate frauds was the reason for the new Companies Act to come into being. I used to call them as Satyam, Shivam and Sundaram. So it's Satyam, Sahara and Sarada. So these were the three popular 3S. We have companies called 4S in Bangalore, but 3S is the reason for Companies Act to come into the new Companies Act. It was piloted by Sachin Pilot, if you know. I mean, he was the Ministry of Corporate Affairs at that particular point in time. It reshaped the legal landscape, a paradigm shift in corporate governance. So many the board aspects, the company's governance aspect got strengthened in the true sense of the term. Transparency. We always say that transparency in the bedroom and bathroom is good, but it moved out to the boardroom also. I mean, that's the type of transparency that we have. Any related party transaction to be routed through the audit committee. So much of, and if you see the disclosures that happen, tremendous amount of disclosure. I don't know whether anybody reads it. Definitely the auditor has to read it. So that's the amount of transparency that is there. Accountability. If you don't do a particular provision, don't comply with a particular provision, well, you are punished severely. Let me give you just an example of deposits. Deposits, non-compliance of the provisions of the Chapter 5 deposits could lead to a penalty of 2 crores to 10 crores on the companies and up to 2 crores to the officer in default, plus an imprisonment of up to 7 years. So accountability enhanced. And finally, ease of doing business in India. When I have kept a lot of exclamatory, punctuation, whatever thing there, that you have to tell me whether it is really ease of doing business. I said Companies Act is much leaner. The engine is leaner. We'll have to, if at all if you have to talk about Companies Act, you can't talk only with the engine, you'll have to read it with the bogies. The bogie that gets attached are the rules. And rules come through notifications. And there is something called the circulars. Every month on month, there are circulars and notifications which keep coming through, which has to be read. Otherwise, you could be subject to a lot of penalties and prosecutions. So, I mean, I'm not going to read this, but you can probably make sense out of it. Tremendous amount of circulars and notifications. There are about 700, moti if I have to say, 197 circulars and 499 notifications issued so far. Some of them overriding the earlier ones, but all in all, you will have to go through all of them. So is it really leaner? Is it really leaner is a question that we have to ask ourselves. So There have been 700 changes which have happened. This is apart from, these are all the minor changes I will talk about, if I have to talk about. But there are major changes in the form of amendment in the Act itself, which we will go through. The Companies Act 2013, what's new? What's new? First of all, I have just highlighted top 16. There may be top 100, which I will cover through my presentation through other slides. But I thought that what I am not going to cover in other slides, I will put it up in one slide. What's new? Wider choice of company structures, one-person company. Is it a popular one? I don't know how many of you have formed a one-person company. 1, 2, 3, 4, 5. We always used to say that India is such a vast country, and whenever you go to US, if you have to ask somebody how to go to another person's house, you don't even find the person to find out. So therefore, there was a GPS. In India, you don't need a GPS. You can always ask anybody. Like that, the point I'm trying to say is, we are a Hindu undivided family concept. So we definitely have more than one person. One person company was not a very popular concept until COVID happened. Until COVID happened. In fact, after COVID, they gave a lot of relaxation to one-person companies. Earlier, there was a requirement for the one-person company to have a paid-up capital of up to 50 lakhs and turnover of up to 2 crores. After COVID, they removed that. So, in short, they tried to make one-person company more popular. There are a lot of advantages with one-person company. One of the greatest advantage I can think of is not to have an AGM. Isn't it? What is AGM? The management has to go before the shareholders. One-person company is like that. So no AGM. Should there be a board meeting? Should there be a board meeting in OPC? The answer is yes, if there are more than one board members. There can be more than one board members in a OPC, but very importantly, a one-person person, that person should be a natural person. He cannot be a other than natural person, and every one-person company must have a nominee who should also be a natural person. So talking about small companies, yes, the fantastic thing, small company is becoming bigger and bigger. You will know what I am saying. Now, it used to be 220, it used to be 5 and something, I don't remember, even 50 lakhs and 2 crores, then it became 220, now it is 440. What is 440? 4 crores paid up capital and 40 crores of turnover. Up to this limit, you are considered to be a small company if and only if, this is quantitative, there is a qualitative aspect also, if and only if you are a private limited company, first of all, and you don't have a father or a child. You know what I am saying. You don't have a father, that is, you are not a subsidiary. You don't have a child, that means you are not a holding company. And also, you are not a Section 8 company. If all these things are complied with, then you are a small company. So what are the advantages of a small company? Greatest advantage to the auditor. No CARO, no IFC, no cash flow, no segment reporting. Now, these are the primary advantages. Disadvantage to a company secretary. Disadvantage to a company secretary, no certification of the MGT 7. Okay? No cash flow statement. So these are the advantages of, and the greatest advantage to the small company is the penalties are restricted to 50% subject to a maximum of 2 lakhs. Now that is the greatest advantage of being a small company. Then we have the dormant companies. Okay? I don't want to talk about dormant companies. Let's talk about active companies. So the second point is incorporation, no registration fee up to rupees 15 lakhs. Don't tell this to the clients. Okay? Entrenchment of articles of association. Entrenchment provisions can be built in articles of association, which means If at all you want to make a provision harsher than the Companies Act, you can do that through your articles. Which means, if for certain aspects there should be a special resolution passed, you can, in your articles of association, say that I have to have 100% majority on approval of all shareholders for that particular resolution to get passed. So that is a possibility built in through 2013 Act. CSR made mandatory, which silently crept in as section 135. Now, do or disclose. That is what was told. You do, you comply, or you disclose that you have not complied. That was how it started off. And then, it went on very harsh, saying that if you do, you have to do it. You have to comply with the provision of CSR. If you don't do it, you will be imprisoned. Fortunately, 135 subsection 7 on imprisonment never became notified. And before it got notified, they removed that. There cannot be an imprisonment for not doing a charity. So now, right now, it is a penal provision and not a prosecution provision. What is the penalty if you don't comply with CSR? The penalty is you shall comply with CSR plus pay 200% of the amount involved as penalty. So I'm not getting elaborate on that. Dividends, transfer of shares also to IEPF for the first time. Earlier, IEPF means only dividends were to be transferred to Investor Education Protection Fund. Through 2013 Act, the shares associated, if somebody is not asking these dividends, that means the owner of the share is also missing. So that also has to be transferred to IEPF. So what else has to be transferred to IEPF? Any unclaimed deposits, any debentures, no? All these things, any share application money or forfeited shares which have not been claimed beyond 7 years also has to be transferred to IEPF. Next, private placement and preferential allotment. Please be very careful when you are raising shares. When you are raising share capital, you will have to follow the rules meticulously. If you do not, I will tell you, how do you raise capital? Public issue, other than public issue. Forget about public issue. Other than public issue, rights issue, ESOP, private placement, preferential allotment. Rights issue we know, existing shareholders. ESOP I don't want to talk. Now we have preferential allotment and private placement. Now what is preferential allotment? I prefer other than the existing shareholders, including the existing shareholders, for allotment. Lot of rules. I have to go in for a valuation, registered valuer has to be there. Open a separate bank account. Open a separate bank account and the proceeds have to flow there. You cannot convert an unsecured loan to an equity. Please note, you cannot convert an unsecured loan to an equity unless at the time of taking the unsecured loan itself, you have collected it as a convertible loan. Like that, there are a lot of provisions, and the ROCs have been giving, and you have to file PAS 3 and a lot of compliances. If you fail, why I am telling this is, if chartered accountants take up this job, take it up meticulously. If any one of them, for example, you have not opened a separate bank account for raising the capital, and you have put it in the same money and you have used the money before filing the PAS 3, the ROC can levy a penalty and tell you to refund that capital. That could be the enormity with which the accountability comes into play. Charge creation. I always say, what is private placement? This has been my favorite topic. What is private placement? Preferential allotment is preferring other than the existing shareholders, including the existing shareholders. Private placement is to prefer Manoj. I want to issue shares to Manoj. I want to issue shares to Mr. Ranganath Acharya. So if I name and give the invitation to subscribe, then it becomes a preferential allotment, a private placement. It becomes a private placement. Always very easy to remember for old people, something called PP call. Remember the PP calls, trunk call and PP call. Those of you who know the trunk call means you will have to go to a booth and ask them to connect. PP means you will have a particular person. You have to ask, Gupta madam, ಗೊತ್ತಿಲ್ಲ ಇನ್ನೊಂದು ಸರ್ತಿ ಹೇಳಿ. Charge creation. Then you if you don't know that, you belong to a better generation. Okay? Charge creation, CHG1. I mean, again, auditors have to comment in their financial statements also whether charge has been properly created. Now, why this charge creation is important? Understand the logic behind that. Because the outsider should know that it has been created. It is not only between the giver and the taker. That is why they said, even if it, let us say, I have taken a loan, I have kept 5 crores deposit with Karnataka Bank. Okay? And then I have actually taken a loan against that 5 crores, 4 crores of loan I have taken. He has marked, the bank has marked a lien on that. He will not repay the FD unless I repay the loan. He knows and I know. But the Companies Act says, even such transactions should be charge registered with the ROC. Why? It is not only sufficient that the husband and wife know, the world at large should know what happened internally. That is the amount of transparency that they want. Because the unsecured loan guy may probably think that that is also available to him in the larger scheme of things. So, charge creation including for pledge and vehicle loans. They said that in a vehicle loan, you could probably go in for a registrar's charge creation. That is not sufficient. It also has to be registered with the Register of Companies. And when? By what date? There are timelines, strict timelines, up to 30 days. 30 days to 60 days, possible by paying an additional filing fee. Beyond 60 to 120 days, 60 to 120 days you can file still by paying an ad valorem fee. That means the value linked to the loan amount. Beyond 120 days, not possible. So you'll have to again enter a transaction and do that. And until such time it is created, the lender is considered to be an unsecured lender. This is what I keep telling the bank lenders. Okay? So obligation for the companies to establish internal financial controls. Although it was there, now it is statutorily told in the Act that the company should bring in internal financial controls and auditors to comment on the existence and operating effectiveness of such controls. Revision of financial statements, possible. Revision of board reports, possible. Subject to Section 130 through a tribunal order or voluntarily Section 131 following all the requirements. Rotation of auditors. All of us know. Now, some of us have been victims of rotation of auditors also. Good. So that familiarity threat is avoided. Rotation of auditors have been brought in. Auditors to attend. I think this is a very interesting thing. I get a lot of questions on this. Should auditor attend the general meeting? Yes or no? Is it a right or a duty? Is it a right or a duty? In 1956 Act, it was a right. Under the 2013 Act, it is both a right and a duty. So which means an auditor has to attend the general meeting unless otherwise exempt by the company. Now who is the company? Who is the company? Company here means the board of directors. Company here means the board of directors has to exempt the auditor from attending. Who can I attend if I am busy on that day? Yes, I can depute another person who should also be capable of being appointed as an auditor of the company. That means I cannot send my article training to attend the general meeting unless exempt by the company. So that's a very important point to be noted. Internal audit, all of us know. Internal audit is required for governance purposes and good accounting or audit purposes, but Companies Act has made it mandatory to have internal audit for class companies. So whatever has been marked in yellow is only for class companies. Compulsory. Then women directors. I always ask this question. I always ask this question to the women. Are you happy with Section 149? Very happy. I will say I am not happy with this. Not because I am a man. Okay? but because I don't think women require reservation for being there on the board. Now, I was in the board of State Bank of India and State Bank of Mysore. We had the State Bank of India chairman, Arundhati Bhattacharya, who is now the chairperson of Salesforce. And when she used to chair the meeting, we felt that she was the only man in the board. Not to be too racist, but the point I'm trying to say is, you don't need reservation. Well, this is there. Women directors, not in every company, all listed companies and all public companies with 100 crores of paid up capital and 300 crores of turnover. So that is the requirement. Related party transactions, clearly defined. Now, what is the related party transactions? Clearly defined, stricter approval mechanisms, including shareholder approval in some cases. Section 188. Section 188 lists out what are all the related party transactions. If there are any related party transactions, first question which we have to ask is, does the company have an audit committee? Audit committee is not required to be there for every company. But if there is a requirement for the audit committee to be there, then every related party transaction has to be approved by the audit committee. If there is no, or even if the audit committee is there, the next question I will ask in the case of a related party transaction is the transaction done in arm's length and in the ordinary course of business? These two questions, arm's length and in the ordinary course of business. Okay? If the answer is yes, no further action required apart from intimating to the audit committee wherever it is there. If the answer is no, any one of them breaching, then you know what has to happen. I'll have to see whether the transaction, then it has to go through a board. I mean, it has to be approved by the board. Now, if such transactions breaches a limit, there is a limit which has been, normally we say 10% limit, but you will have to look into different, there are about 9 related party transactions which have been defined under 188. So if you have any one of them breaching the limit, then you have to get a shareholder approval, prior shareholder approval. Earlier it was special resolution, now it is ordinary resolution. Now, why is it all important for the chartered accountant community? Please note, all these may be operative sections in the Companies Act, which the company secretary has to take care of. But in our CARO, in our so many reports, we'll have to comment on the compliances of those particular sections. Secretarial standards, standards on auditing, accounting standards, all of them have been made mandatory in the Companies Act. Since chartered accountant is no such standards on auditing, I thought secretarial standards, how many secretarial standards are there? 10. First 4 are mandatory. At least what are the mandatory standards? One is board minutes, general body minutes, general body meeting, board meeting, general body meeting. Then we have dividends and we have minutes of the meeting. These are the 4 standards which are mandatory to be complied with by the company, of course. NCLT instead of CLB. If you know the full form of CLB, then you belong to the earlier generation. Right? Company Law Board, Bureau of Industrial and Financial Reconstruction. All these things, if you know, then you are belonging to the 1956 block. Class action suits. That means shareholders can complain against the chartered accountants or against the directors or against any particular community as a group. This is built in for the first time. Then we had a lot of filings to do with the ROCs. Very beautifully named for the first time. Earlier it used to be Form 1, Form 32. If you know what a Form 32 is, even now some people say Form 32, which means they are not refreshed. Have you filed Form 32? Today articles will not even know what is that Form 32. Like you should know, the first time my boss told me to go and get a Form 1, I was so happy. I went to the industrial and commercial prints and said, give me Form 1. He told me which act. I didn't even know that there was a different acts, and Form 1 means I thought Form 1. Then again I had to go back to the office. In those days no mobile. No? So those were the good times that we had. Now you have at least no Form 1. You have ADT1, ADT3, DDT1, DDT3. So all these forms have to be familiarized with. Let me talk about the important. Now in one of the 4 conferences I talked about the Shodasa Samskara, starting with Garbhadana, ending with Antyeshti. And that is our Hindu traditions, Shodasa Samskara. In that Shodasa Samskara, for a company, they warn you enough before forming a company, right? Before forming a company, they tell that if you form a company, they will give you a SIN number. Telling you very clearly that it is a sin to form a company. In spite of that, if you go ahead and form a company, you will have to do the Shodasa 9, more than Shodasa Samskara. It starts with the spice and agile, INC 20A. What is this INC 20A? Within 6 months, within 180 days from the date of incorporation, you will have to ensure that you bring in all the assured capital and have given a registered office address before you start your business or exercise your borrowing power. Then we have DPT3, borrowings. Now please understand, borrowings, what is a borrowing? What is a deposit? Sorry, what is a deposit? How is deposit defined in Companies Act? Very simple. Any money borrowed by the company is a deposit. Any money taken, forget about borrowed, any money taken by the company is a borrowing. I will put it in a different way. If it goes and sits in the balance sheet. Right, sir? I mean, to that extent, maybe money taken being as a revenue item need not be a deposit. So any item which goes and sits in the balance sheet is a deposit, unless it falls into any one of the 18 exempted categories. Any one of the 18 exempted categories. The popular 18 items, a few of the popular exempted items are, what's that? Advance received from customers. Advance received from customers up to 360 days. 360 or 365? 360? Okay, 5 days extra, 365. So I'm saying that advance received beyond 1 year can become deposit. Deemed deposit. You may call it as deemed deposit, but it is deposit. It is deemed to be deposit. Okay, what he's trying to say is there is a green deposit. I always use this green deposit, blue deposit, and then there is a red deposit. That means you have complied with the requirements of the deposit rules and collected deposits, then it is deposits. For example, companies are entitled to take monies from their shareholders up to 100% of their paid up capital, free reserves and security premium account. In a private limited company. In a public limited company, up to 35% of the money from the shareholders can be taken. Beyond that, it could become a red deposit. What I am trying to say is deemed deposit is as good or as bad as deposits. Okay, you have not collected it as deposit, but it is deemed to be deposit. And if you have not complied with the requirement of the deposit rules, then it becomes a red deposit, 2 crores to 10 crores penalty. Okay? So very, very serious provisions. Money taken being deposits, not considered. Share capital. If you have taken share application money, within 60 days it has to be allotted. Otherwise it could become a red deposit. What else will come under green deposits? Monies received from directors. Monies received from directors are green deposits. What about relatives of directors? Relatives of directors is green in a private limited company. Am I clear? In a private limited company, it is considered to be okay. Who is a relative? Who is a relative? If I am a director in a company, can I take it from my grandfather? Can I take it from my grandfather? Because grandfather is a relative. Right? Not right. Grandfather is not a relative under the Companies Act. Hello, sir. Companies Act definition of relative is different from the definition of relative under Income Tax Act. I mean, my simple definition for Income Tax Act is Aju Baju, Aage Piche, Upar Niche. Okay? Aju Baju, husband and wife, Upar Niche, linearly ascendant and linearly descendant, Aage Piche. Aage Piche means brother and sisters. So this is the definition of relative under Income Tax Act, general definition. There are other specific definition under 56(2)(7) and all. I don't want to talk about that because gifts can be received from a relative. Gifts can be received from a relative. Gifts cannot be given to a relative. I don't know what lunch you have given, but I am just trying to play with words. I can take gift from my mother's brother, my Mamaji. But I cannot give gift to him. It is built on the Hindu tradition. Under the Hindu tradition, Mamaji should give the gift to the Bhatija, not the other way around. So that has been very beautifully built in. So gift can be taken from a relative, gift cannot be given to the same relative, unless it is a relative on that definition. So having said that, who is a relative under the Companies Act? Aju Baju, just upar, just niche. Just upar, just niche, aage piche. Aage piche. And then, so Aju Baju means husband and wife, just upar, just niche means mother, father, son, daughter, and they have brought in two more consolation. Son's wife, daughter's husband. Why is son's wife? Who is son's wife? Daughter in which law? No, you know. Daughter in company law, son in company law. So that is how it has all come out. So, but on a serious note, grandfather is not relative. You have to keep this in mind. Okay? So, moving next, MSME, dues more than 45 days. Dues more than 45 days to MSEs. Please understand, although the Act talks about micro, small and medium enterprises, there is no benefit to medium enterprises. We are talking about only micro and small. I mean, I should probably use micro here, micro and small. Who is a micro and small? I will go up to small, which is 50 crores and 250 crores, right? 5 crores, 50 crores, 250 crores turnover, and 20% of that, so which means 550, 50 crores of turnover, and 20% of that, which is 10 crores of investment in plant and machinery. That means up to 10 crores investment in plant and machinery and up to 50 crores of turnover, the entity is considered to be a micro and small enterprises, which means all chartered accountants are so. Right? So we can also get covered under the benefit. What is the requirement under the Companies Act? There is nothing. Under the MSMED Act, they have got protections. Under the Income Tax Act, do they have protection? Yes. Do they have protection? Income Tax Act, they don't have protection. The person who is required to pay has a difficulty. And that person can mostly be an MSME only. I don't know whether you understand what I said. The person who has to get the MSME payments disallowed will be mostly the MSEs only. So serious a provision, sir. You must tell all your clients that if you don't pay my audit fee or any, first you tell that, or any other expenditure before 31st of March, up to 31st of, they don't talk about 45 days, up to 31st of March, that entire expenditure will be disallowed. Now please note, in a company or in any entity, if the purchase is 1 crore, if the purchase is 1 crore and he has sold it for 1 crore 10 lakhs, what is the profit? 10 crores or 10 lakhs. 10 lakhs is the profit. So he should pay income tax on 10 lakhs. Now there could be a situation if this 1 crore is not paid within 45 days up to 31st of March, the entire 1 crore ka he has to pay 30%. You may say next year when he pays, it will be allowed. Next, this benefit of this is not allowed until the due date of filing the return. It is only up to 31st of March. The benefit beyond the year is allowed if the due date of 45 days is allowed up to the balance period. The point I am trying to say is very harsh provision, and mostly it could impact the MSEs only. Because large companies take an undertaking from the supplier that he is not an MSME, even if he is an MSME. These are the problems, practical problems. Okay. So what is the Companies Act obligation? Such an MSE, any entity has to file an MSE 1 form every 6 months saying that what are the overdues with reasons. Overdues with reasons. CAG 1 and 4 we talked about. ADT 1 we are familiar. ADT 1 has to be filed within 15 days from the date of appointment. Fortunately, there is no ratification required. Earlier we had a very big confusion. Although you are appointed for a term of 5 years, every year it had to be ratified. Now that is gone. Okay. Now ADT 3, resignation of auditors, to be filed by the auditors only. To be filed by the auditors within 30 days. Within 30 days, if he doesn't file, the new auditor cannot file the ADT 1. That is the mechanism, because the SRN of that has to be put. AOC 4, MGT 7, PAS 3, return of allotment we talked about, SH 7, increase in authorized share capital, MGT 14. I think we will see that section 117 was the most, changed section. The section which underwent several amount of changes is section 117, that is MGT 14 filing. Niranjan Prabhu is not there. Otherwise, we used to always talk. Company director, Yadre MGT 14, Kutkondre MGT 14 file Modboku. Kemudre MGT 14, Utamadre MGT 14. So you have to file MGT 14 for everything. So for every act, please check whether MGT 14 has to be filed. In minimum, at least 14 MGT 14s have to be filed. When I always keep, that's why they said MGT 14 there. So any special resolution. I think we have a slide here. Yeah, what are the cases where MGT 14 has to be filed? All special resolutions. Resolutions agreed to by all members. Now what are those resolutions where all members have to agree? I told you of one situation called entrenchment. Entrenchment. Now if in the articles all members have to agree, if it is there, then it is a resolution to be passed by all members. So that could be one. And let us say a private limited company is already formed now, and they did not have this entrenchment provision in their articles. Now they want to bring in this entrenchment provision. Then that articles of association, in the normal situation, any change in articles of association has to be approved by a special resolution. But because of this provision which has to be approved by, in future it has to be approved by all members, now also this provision has to be, this change in the articles has to be approved by all members. So that is a point to be noted. Board resolutions relating to appointment, reappointment, renewal, variation of terms of appointment of MD. Now for the sake of income tax, sometimes we would probably increase the remuneration of the MD during the year, maybe during advance tax. Now that what happens is, you would forget to file the MGT 14, unless you have an in-house company secretary or a company secretary who is really working on the company. So these are all things, if the chartered accountant outsources this particular work, please be careful that you will have to look into holistically. Resolutions are agreements which have been agreed to by any class of members. Voluntary winding up a resolution. Resolution passed by board under section 179(3). Only this, there are certain resolutions which has to be passed by a 179(3). So let's go to 179(3). One of the popular things under 179(3) is a resolution has to be passed by the board for various activities, including for approval of financial statements. That is how we say the board has approved the financial statements, means through a resolution. For passing that resolution, an MGT 14 has to be filed. Fortunately, not by a private limited company. Any other resolutions or agreement placed in the public domain. So you look at this, what is the penalty for not filing MGT 14? The penalty could be on the company. It used to be as high as 5 lakhs to 25 lakhs. Then they made it different. Now it is 10,000 to 2 lakhs. 10,000 to 2 lakhs. Officer in default, 10,000 to 50,000.
Okay, Mara.
If the chartered accountant has outsourced the work of doing the secretarial work, and if he has not filed the MGT 14, who is the officer in default? And look at this, this is a very serious issue. So therefore, I always keep telling, if at all you are doing a company law practice or a company law consultancy, you will have to know the complete, and especially tomorrow I'm going to Hubli to talk about the same subject, similar subject, private limited companies. There may not be many chartered accountants who are dealing with lot of companies, but I warn them, even if you have one company as your client, you should know all the 470 sections and 7 schedules. Because you may commit a mistake if you don't really comply with any one of them. And look at this, officer in default 10,000 to 50,000 rupees. Unmindfully we say, how many directors you want in your company? They say 7 directors, 8 directors, 9 directors. Tomorrow when the penalty comes, it will be all those 10 directors. So lesser the number of directors, lesser will be the penalty possibility. We talked about this. DIR 12 is the S12 form number 32. DIR 11, now this is very interesting. What is DIR 11? DIR 11, today we might have forgotten it. Every director who resigns, I resigned from the company, I had to file a DIR 11 and the company had to file a DIR 12. Now DIR 11 is made optional. That means if I resign and the company has not filed the DIR 12, then I will file my DIR 11, so that I am telling the world at large that my obligation as a director stops on this particular date. If the company does not file, I will file. So it's an option which is made. Earlier, to begin with, it was not an option. It became an option in between. MR 1, return of appointment of MD, whole-time director. INC 22, we are familiar with. BEN 2, let me talk about BEN 2. What is BEN 2? Significant beneficial owner. Section 90. There are two sections, section 89 which was there for a long time. Section 90 was also there, not that it was not there, but it was not empowered enough. Section 80 talks about registered owner and beneficial owner. That means we know of companies which are 100% holding, 100% holding. And we know that if it is 100% holding, that means all the shares of this company is held by this company. But then, there must be minimum 2 shareholders or minimum share 7 in a public limited company. How can that be complied? Then we will say, we will nominate, this company nominates. So they are called nominee shareholders and this is the beneficial shareholder. So the nominee shareholder and the beneficial shareholder should give MGT 4 and 5 to the company and company should file an MGT 6 to the ROC. So that is what is being talked about in the next beneficial, that is section 89. Section 90 is significant beneficial owner. Now who is a significant beneficial owner? Now in a company, who is my shareholder? Mr. A and Mr. B, no problem. Mr. A and Mr. B are individuals in life and blood. So therefore, there is no need to act on section 90. The objective of section 90 is to find out the ultimate individual behind the shareholding. Which means, if this company, the shareholder is another company, I would like to know who are the shareholders of that. Then if I say this company A, shareholder is company B. In company B, who is the shareholder? LLPC. In LLPC, who is the shareholder? Trust M. In Trust M, who are the beneficiaries? Who are the beneficiaries? So finally, I have to go to the root. If I may have to say the recent thing, living root. So now living root bridge. Okay, I'll talk about that. The living root bridge in Meghalaya, Chirapunji ke paas. I was there last week at this time and that route. So I'm saying, talking about this. So who is the root? Who is the person behind that particular? Who is the individual? Who is the ultimate beneficiary? How do you determine that? How do you determine who is this ultimate significant beneficial owner? There are rules told. Simply speaking, any person who is holding more than 10% ultimately and having the control over the company will be a significant beneficial owner. Paucity of time, I may not get into it, but let me just give you a simple example. In company A, company B is 70% shareholder and there is Shriman XYZ, I mean an individual. So 70%, then I will go to 70%. The obligation of this company now, this is called a reporting company. The reporting company will have to issue a, what Ben? Ben 3 or say, or whatever. They have to give a Ben 3 to them and find out who are all the significant beneficial owners, who are your shareholders. So in this company, so company A and company B is 70% shareholder. In company B, who are the shareholders? Company B is 70%. In company B, B1 and B2 are the individuals. B1 and B2 are the individuals. B1 is holding 80%, B2 is holding 20%. So 80% into 70, how much sir? Whatever, okay? Then you have another person, 20% into 70%, 14%. Please note that although this person is holding 14%, he is not holding more than 50% here. He is not a majority shareholder here. So therefore, this guy has to be eliminated. So there are rules like that. We have put up Excel sheets to find out who is a significant beneficial owner. You will have to do a calculation to find out. He must first of all be a majority shareholder here and holding more than 10% ultimately in my company through the multiplication factor. So that becomes the calculation of significant beneficial owner. Let me tell you the good news. The good news is whatever is applicable to companies from this month onwards is also applicable to LLPs. Also applicable to LLPs. So all the provisions, I don't know, our institute came out with the standards on auditing for LLPs, sir. I don't know why, how is it different from a company, because I thought standards and auditing are universal. They have made it for LLPs, the draft order has come out. Okay. Then one, beneficial interest, AOC for all the things are, I mean last of course is very important, STK2, application for strike off, that is in case you want to wind up the company. Let's proceed further. I think this is one slide which I have been using for the last 10 years. That means from the time the Companies Act 2013 came, I was using this slide. The only slide which has not changed over a period of 10 years. So what does it say? As an accountant, how I look at the Companies Act. In a balance sheet, share capital, I cannot issue share capital at a discount for the first time. Earlier we could have issued shares at a discount, except sweat equity. Except sweat equity. Preferential issue of shares. We just now saw what are the preferential issues at a value determined by the registered valuer other than rights or ESOP. Preference shares, redeemable. Compulsorily, all preference shares must be redeemed. You cannot have an irredeemable preference share anymore, except in the case of an infrastructure project. Who is an infrastructure project? Defined, normally concepts are defined in section 2, but very interestingly, infrastructure has been defined in schedule 6. And why schedule 6 was very important, you know. Erstwhile schedule 6 was current schedule 3. Again, you can understand this only if you know 1956 Act. 1956 Act mein, schedule 6 was the format of balance sheet and P&L. Reserves and surplus. Mandatory transfer to reserves before dividends made optional. Under the 1956 Act, if you had to give dividends, there is a percentage. If you give 20% dividends, there must be some 5% transfer to reserves. 20 to 40%, 7.5% transfer to reserves. Now, transfer to reserve is an option. You don't have to do it at all. Deposits, we have seen. Share application money 60 days. Advance from customers, I'm sorry, this was 180 days, now it is changed. Stringent norms. Another important point to be noted is any money taken from another company, is always removed. It was removed. Deposit in a separate bank account 20% of the amount repayable in the next year by 30th April. So these are all the requirements. On the other side, investments. I cannot have investments in company A. Company A invests in company B. Company B invests in company C. ऐसा नहीं हो सकता है. The maximum amount of layers in an investment company can be 2. Beyond 2, it should be a operating company. 186. Loans to directors. Loans to directors, provisions are made very harsh in 2013 Act. In fact, it has been diluted now. Initially, loans to directors or entities in which the directors are interested could not have been given. Now they said, what they did in 185 now is, they made directors and entities in which the directors are interested non-corporates, and entities in which the directors are interested corporates. So section A, section B, that means non-corporate including directors, and entities in which, companies in which the directors are interested. So there, to these people, a company can give a loan provided a resolution is passed by the members and this company uses it for its own business. Initially when 2013 Act came, sir, there was a blanket ban for companies to give loans, not only loans, guarantees and securities could not have been given. Now there is a possibility to give the thing. So except to managing director, whole-time director, as per service rules, to all employees and with special resolution by members. You can give it to a director if at all he is a managing director or a whole-time director, and such a scheme is allowed to all the employees, because after all he is the first employee. If it is given to all the employees, he can also be given, and with a special resolution by the members. In case, look at this, in case there is a breach of loans or breach of deposits provision, okay, what happens? One is penalty. We talked about the penalty of 1 crore to 10 crores and officers in default 7 years plus up to 2 crores penalty. After paying this, he has to repay the deposits also. He cannot keep the deposits. It is not as though you have paid a fine and still continue with the crime. You have to undo the crime and pay the penalty. Similarly, loans. You have to return the loans and pay the penalty. And this, I think, in a short, I'll just show you. I've been showing this in so many forums. Acceptance of deposits. Money received can either not be a deposit, green, or could be deposits. If it is neither blue nor green, it could be contravention straight away. If it is deposits, it could be either from members, that means the shareholders, or from non-members, which means public, which can be taken only by eligible public companies under section 76, and from members. It depends whether you are a private limited or a public limited. In a public limited company, you can take up to 35% of the net worth. What is net worth? Please don't understand net worth like in the banking terminology. Here I have used it very loosely. Actually, the word used is 35% of paid up capital, free reserves, and share premium or security premium account. What else is kept out? Please understand, P&L account credit balance. I always keep telling, whether it is reserves and surplus is a one word or two words. Whether reserves and surplus are two different things or whether it is one. It is two different. Reserves are reserves and surplus is your P&L account credit balance. So when we talk about declaration of dividends out of reserves, you see, it is possible to declare. You don't have to apply declaration of dividends out of reserves. Let us say my year profit, this year's profit is 1 crore. And I want to declare dividends of 3 crores. Should I go and apply declaration of dividends out of reserves? The answer for that is, first of all, I will see what is my accumulated profit in my balance sheet. If my accumulated profit, that is P&L account credit balance in my balance sheet is 5 crores, that means 1 plus 5, 6. Out of 6 I can give 3 crores. I don't have to apply the declaration of dividends out of reserves. So reserves and surplus are two different animals, not one animal in that sense. So yes, so private limited companies can take up to 100% of the net worth, or in fact if there are certain conditions complied with, then they can take any amount. There is no restriction. You can take any amount from the shareholders in case in such a company there are no associates and subsidiaries. No associates and subsidiaries. Borrowing from banks and financial institutions is less than 50 crores. And such borrowings divided by paid up capital is less than 2. They have given some formula. And no default in repayment of such borrowings. So if this condition is complied, the company can borrow any amount from the shareholders. And from an eligible startup, for the first 10 years from the date of incorporation, without complying with that condition, it can borrow any amount. Already seen this. Let's go to this. Also to private limited companies. CSR is applicable if in this year, please understand, in this year, my turnover is more than 1,000 crores, my net worth is more than 500 crores, or my profit before tax, I'm using the word because they use the word profit, I'm using profit before tax, is more than 5 crores. 5 crores. In this year, if it is more, that means in 23-24, if it is more, when should I spend this CSR? In 23-24, it is more. Please understand. Should I spend it in 24-25? No. In 25-26, I have to spend. Because I will know this criteria only when I complete my balance sheet next year. So I just put it forward, backward looking. If my profit of 21-22, I mean any one of these breaches is breached, then in this year I have to do. So immediate preceding previous year is the criteria and not the immediate previous year. Internal audit, borrowings, even for a private limited company, if the borrowing is more than 100 crores and turnover is more than 200 crores, rotation of auditors, even to a private limited company, the paid up capital is more than 50 crores, borrowings or deposits is more than 50 crores, whole-time company secretary 10 crores, paid up capital, CARO we have seen, MGT 7, MGT 8, vigil mechanism, secretarial audit, cost audit is also applicable to a private limited company. Next, let's move through the next half an hour exactly. I'll try to finish off the balance of the journey. So we are going from I use Mangalore to Udupi, have a halt in Mulki. Those of you who are from South Kerala will understand this. So we are now slightly crossed 50% of our journey. The balance 50% of the journey is towards whatever amendments that have happened. There have been 4 major amendments, 2015, 17, 19 and 2020. And there are certain changes in the Companies Act necessitated out of the Finance Act, out of the IBC and out of the tribunal. I'm not talking about the 5, 6, 7, 8. As I've already shown you, most amended section was 117 dealing with MGT 14. Number of removal of difficulties. There are 2 sections dealing with the removal of difficulties, section 462 and section 470. That is the last section. Section 470's life is over now. Because if at all there are any difficulties in the application of the Companies Act, for the first 5 years they could make any changes. The ministry itself could make any changes. So that is section 470. If you remember small companies, those of you who remember and good in English, in the first deliberation, small company is a company in which the share capital, paid up capital was less than X and they said or. Instead of using and, they use or using and. So all those changes, they made it using 470. 462, lot of liberties were given to certain class of companies, such as private limited companies. For example, they said, you can take deposits from a relative of a director. Now, certain provisions of the Companies Act are not applicable to private limited companies were told in notification issued under section 462. Private limited companies, section 8 companies, Nidhi companies, government companies and International Financial Service Center, they gave out 462. So let's go through some of them, 15, 17, 19 and let's skip this. I'll see if I can take this a bit later on. Let me finish on this. Companies Amendment Act 2015, major changes. Minimum paid up capital dropped. I mean, if you remember earlier, sir, 1 lakh and 5 lakh. So now it's gone. Common seal is made optional. Earlier we had a hammer. Right? Now it is made optional. Please note, if your articles of association still has it, you cannot just throw the hammer in the dustbin. You will have to give it a proper antyesty by making an amendment in the articles of association. To begin with, if you are incorporating any companies, you don't have to bring in the concept of common seal at all. Prohibiting public inspection of board resolution under 179.3. We just now saw 179.3 resolutions, right? These are all the resolutions, which is not a public document. But I am told from my office that even this, being an attachment to MGT 14, still can be viewed by anybody. There is no mechanism built in to make it not a public document. Fraud reporting by the auditor to central government. Now, section 143 bracket 12 talks about filing of an ADT 4 with the central government by the auditor in case he comes across any fraud. Okay? So, you don't have to report it through an ADT 4 if the fraud value is less than 1 crore. To whom should I report them? To the audit committee if there is one. If there is no audit committee, then I report it to the board. Audit committee of the board empowered to give omnibus approval for related party transaction on an annual basis. I told you, any company doing any related party transaction should report it to the ACB if there is one. And such an ACB can give an omnibus approval. That means they did not go through every approval. Up to 1,000 crores you can do this transaction. So that is an omnibus approval possible. Replacing special resolution with ordinary resolution for approving related party transaction. I told you, if the transaction between related parties are done not at arm's length or at arm's length but not in the ordinary course of business and it breaches the threshold specified, then it has to go through a member's approval through an ordinary prior approval. Exempted related party transactions between holding and wholly owned subsidiary. That's about 2015 major amendments. 2017, the amendments were ratification of auditor's appointment every year has been scrapped. Now once an appointment is done for 5 years, he will be there for 5 years. Otherwise there was no point. He's appointed for five years and then if you give me a clean report, I will ratify. I mean that was so that is not possible now. Auditor to report on adequacy and operating effectiveness of internal financial control with respect to financial statements instead of internal financial controls in total. When all of us know that internal financial controls can have two aspects. That which deals with financial systems, financial reporting, the other one is aspects which do not impact the financial reporting. While the management is in charge of everything, we as auditors are responsible only to report on that which has an impact on financial statements. Please note, although the Companies Act uses the word internal financial controls with respect to financial statements, our guidance note uses the word internal control systems with respect to financial reporting. We call it as IFO car. So there is a small mismatch, nevertheless meaning the same. Rationalization of provisions relating to section 185. Just now we talked about loans to directors. Earlier there was a blanket ban. Now they said for a corporate you can still do provided conditions are given. Providing for maintenance of registers of SBO by clearly defining SBO. We talked about significant beneficial ownership. Stringent penalties in case of non-filing of financial statements and annual return every year. Later on they diluted it, so therefore I will not talk about it. Making offence for contravention of provisions relating to deposits as non-compoundable. Look at this, very, very serious. Up to 10 crores, up to 2 crores, non-compoundable. You cannot, reduce it and pay a smaller amount. Board report size reduced. Some information can be given in the company's website. Filing of DIR 11 is made optional. Replacing the requirement of approval of central government for managerial remuneration through shareholders approval. Now, if you have to give managerial remuneration, there is a limit which has been prescribed under 197 or 198, applicable only to public limited companies. Beyond that, if you want to give, earlier we had to go to the central government, now it is possible through the shareholders approval. 197 or 198 not applicable to private limited company. Simplification of the process of private placement, although it is still not very simple. Rationalization of the provisions in the Act, hitherto mentioned only in the rules. Nakas changed to Nafra. For the first time, we are seeing a lion entering. Okay? Nakas was a cat converted to a lion in the form, and additional provisions applicable only to listed entities. 50% of the applicable penalties for OPC or small companies with respect to non-filing of annual return, financial statements and MGT 14. Major changes in 2019. Several non-compliances liable to penalty instead of fine. Now, what is the difference between a penalty and a fine? A fine could be levied only by the court, whereas a penalty could be levied by the adjudicating authorities, which is ROC or RD. So, fine means it had to be levied. So, declogging of the NCLT in that sense. Decriminalizing procedural defaults. Lot of imprisonments have been converted to penalties. For example, failure to file financial statements and annual return in prior to 2019 was liable for fine with imprisonment. Now it is imprisonment is removed, fine ke badle mein penalty. Reintroduction of declaration in form INC 20A, which we saw. Every company making this is very serious. Every company making public offer and such other prescribed class of companies shall issue securities only in demat securities, demat, and securities shall be held on or transferred only in demat. All these days, all listed companies, all public companies were required to have a facility for dematerialization of securities. And future issues by the such companies have to be done only on dematerialized basis. Any transfer of shares, they cannot force an existing shareholder to dematerialize it. But in case he comes to me for transfer, I will not do the transfer unless it is dematerialized. These were the provisions so far for a listed company and public company. Now please all of you note, if you are advisors to any private limited companies, from September 2024 onwards, all private limited companies being non-small, that means 440. If you are any one of them being higher, more than 4 crores paid up capital or more than 40 crores of turnover, then such companies should provide a platform for what we say facilitate transactions of in dematerialized form. So please warn all your clients. If you don't do that, it could amount to void. The transaction will be void. So any transfers, any allotments and transfers exist. But the company has to get this ISIN number, right? ISIN number and facilitate. You should register with the CDSL, NSDL portal and keep yourself ready for that. Yes. The company should say, I am ready, my thing is available. Yeah? So every company responsible to take necessary steps to identify an individual who is an SBO, we already spoke about it. CSR provisions strengthened. In 2019, for the first time they brought in imprisonment for not complying with the CSR provision. Of course in 2020 it got diluted. A person shall be disqualified if he accepts appointment of a director in more than 20 companies. 2 times the penalty for repeated same default within 3 years from the date of order imposing such penalty. That means if the penalty for the same offence you are committing again, then it will be 2 times if you have committed the same offence within 3 years. Companies Amendment Act 2020, last of the amendments. Changes in CSR, 135. CSR committee not required if CSR spending is less than 50 lakhs. Board itself can comply with that. Set off excess amount spent on CSR in a particular financial year towards such obligation in subsequent financial years. Very interesting, we had to deal with one of the situations. CSR, company's profit was more than 5 crores. And they had a profit on sale of fixed asset. Whether that profit on sale of fixed asset also is to be reckoned for the purpose of CSR? 198 very beautifully builds in profit. Profit means you will have to consider profit also on sale of assets, fixed assets, or I think they use the word fixed assets or immovable properties. You don't have to take into account capital profits. You don't have to take credit of profit of fixed assets and immovable property beyond the value. I mean, they have given in section 198, the same calculation as 198 has to be used. What we use for managerial remuneration, the same profit has to be used for CSR. The question that they said is, it's given a very confusing wordings there, but on a common sense basis, it is very easy to understand. If I have sold an item for 2 crores, and I had actually bought that item for 150 lakhs. Look at this. I bought the item for, I bought, let us say, a building for 1.5 crores. And now I am selling it at 2 crores. Now, the actual, and the 150 depreciate, okay, it has now come to, let us say, 80 lakhs. Depreciate, okay, it has come to 80 lakhs. So what is my profit on sale? 2 crores minus 80 lakhs, 1 crore 20 lakhs is my profit. Then they use a very complicated formula to arrive at very simple, 2 crore minus 150, 2 crore minus 150, 50 lakhs. When you don't use any of these calculations, you just say whatever is the sale price minus your original cost price, which is 150. 50 lakhs, you don't have to include it in your net profit calculation. That much you can exclude. And in one of the cases it had gone up, and fortunately they had not spent, and they came to us and anyway they had profit on sale of such thing, and said, okay, it is within 5 crores, don't need to do CSR. But anyway, I think we as chartered accountants have an obligation to actually further the CSR also. If it is there and the company has the ability to pay, ask them to pay. Part of their punya you also get, right? Manoj? Okay. Penalty for non-compliances we have seen. So what was prosecution got converted to finally penalty. How much? 200%. 200%. Plus incur CSR. Second point, very important. Central government to prescribe certain class of unlisted companies. Listed companies is there. Unlisted companies who shall prepare their periodical, audited or limited review financial results and file it with the ROC within 30 days of completion of the relevant period. Brought in 2020. I think because of COVID, they have not really made it active. If it is made active, even private limited companies, because it is not restricting to only public limited companies, even private limited companies with borrowing of 100 crores and above. Now you see they sort of brought in through CARO and Schedule 3, is your books of accounts matching with your stock statements? No? Like that, give a limited review report quarterly within 30 days from the end of the quarter, could come for all unlisted companies belonging to a particular class, for the moment still not notified. Lower penalties for all defaults. Earlier we saw for certain defaults, now for all defaults for small companies, OPC, producer companies and startups. The good news for us small companies, all penalties are 50%, subject to a maximum of 2 lakhs. Fourth point is thankfully good for all other companies other than small companies. Penalties for not filing annual return, financial statement NGT 14 and ADT 3 within the due date reduced for all companies, maximum 2 lakhs. There could be so many companies which are still not filed AOC 4, MGT 7, ADT 3 or MGT 14. For them the maximum is 2 lakhs. The next one is still better. If not for this, you will see what? Section 454 read like this. For defaults, for not filing annual return, there could be a penalty also. Apart from the additional filing fee that we pay, today filing fee for not filing a balance sheet or annual return is not only the filing fee plus 100 rupees for every day of default. 100 rupees for every day of default. Then there was a penalty also of 1 lakh. Something like that. So now what they said is, for default relating to non-filing of annual return or financial statement, and such default has been rectified either prior to or by the adjudicating officer, no penalty shall be imposed. That means you still have time. Including provisions of Part 9A, Producer Companies of Companies Act 1956. In fact, producer company, I don't deal with any producer company, but those of you who are dealing had to refer to 1956 Act till 2020. Okay? Just like we used to refer to the 1956 rules for the purpose of accounting standards. Now, for the purpose of accounting standards, we used to refer to Companies Accounting Standard Rules 2006 until 2021. That was the Rule 7 bridge, which said that until this is formed under your Act, you refer to 1956 Act rules. In 2021, we got our own rules. Till such time, we were using Manor Gupta sir's rules. Including the rights issue offer must be kept open for minimum 15 days and maximum 30 days. Okay? For private limited companies with a consent of 90% of the members, it can be less than 15 days. However, for all companies, they have now reduced the minimum number of days to 7 days. So that's about Companies Act amendments over the 4 different amendment acts. The final 3 slides. Companies Act, continuing relaxations due to COVID. Earlier, board meetings could be conducted through video conferencing. We could conduct before through video conferencing, but there were at least 5 items. If you take up these 5 items, the directors should be physically present to take up these 5 items. What are they? Approval of annual financial statements, approval of the board report, prospectus, audit committee meeting for considering financial statements, approval of matter relating to amalgamation, merger, demerger, acquisition and takeover. The good news is, after COVID, all these could also be done under video conferencing. Extraordinary general body meeting and annual general body meeting can be conducted through other audio visual means. Until they have been extending it every year, until last year, until this year, 2 months back, that was the last date. So up to September 23, you could still do it under the VC basis. Sharing annual report to shareholders electronically was also permitted. Let's see some rights. Now, what are all the various penalties that could be possible for non-compliances? Non-filing of INC 20A within 180 days from the date of incorporation. 1,04,000 rupees. Company has incorporated, just no filing fee, right? That was the andar aaja baad mein dekhta hu. So no filing fee for up to 15 lakhs authorized share capital, and then he has not filed this INC 20A, he had to pay 1,04,000 penalty. Not mentioning company's address in the letterhead. Registered office address is very important. Not mentioning SIN on the letterhead when documents filed with the ROC. At least for those documents which you file with the ROC, you should be very careful. Not filing form PAS3 to ROC within 30 days of allotment of securities. Not opening separate bank account, we saw this. 5 lakh rupees penalty. ठीक है बाबा 5 lakhs ले लो. But return all that you have collected. You look at this, how do I pass an accounting entry? What will happen to my balance sheet, my bankers? Look at the implications, tremendous amount of implications. EGM was not called for approving the issue under private placement. Not issued share certificates within 2 months from the date of allotment. Now please understand, how will the ROC know whether it is share certificate is issued within 2 months or 3 months? If you are having a husband and wife company, no problem. But if you are having a bad husband and a bad wife company, people who do not have good relationship, in short, not only they will have a problem against them, the auditor also will become a collateral damage. So you should be very careful on that scenario. Not filing form SH7 within the prescribed time limit. Non-maintenance of register of members as per the provision. I mean, this sometimes the ROC could take up inspections. Now that the ROCs have been relieved of their mundane works, everything is centralized or everything is faceless. So now they can actually say, I would like to come and see all your minutes, all your registers, all your SBOs, and then you are getting caught. Not filing form bent to within the prescribed time limit. Not filing MGT 14. Incomplete disclosure of matters in board report. And imagine if this board report is prepared by the chartered accountant. And he has taken only 25,000 fee. What is the penalty there? 4 lakh rupees. And that could be the seriousness, no? Non-dispatch of financial results to the members as per the provision. How will the ROC know? ROC will not know. There is one shareholder, who is now going to, who is with the Shakuni there. The non-appointment of internal auditor by the private limited companies. Although private internal audit is required only for class companies, being a class company, not having the internal auditor or the company secretary, or not filing DIR 12 for change in, look at this, change in designation from chairman to chairman and CEO. We take it so casually, so the company has to pay 1 lakh for that. Penalty orders against chartered accountants. Why leave them? There is a NAFRA and there is an ROC. So what did the NAFRA do? How will the NAFRA come to know? Is of course one is through the public complaint, one is through newspaper announcements. The other one is from our institute only. Institute has a financial reporting review board. Writes to the MCA. MCA writes it to NAFRA. 5 lakhs penalty on the chartered accountant and debarred for 10 years from being appointed as the auditor, internal auditor of any company or body corporate. What was the mistake? EOM paragraph misused to cover misstatements. Now please understand, we have an SA 700, SA 705, SA 706. 700 clean report, 705 modified opinions, and 706 is for emphasis of matter and other matter. This emphasis of matter is not a via media between clean report and modified opinion. If it has to be every emphasis of matter has to very clearly say it is not a modification of the opinion. It is not a modification of the opinion. And then you give a reference to a matter. In fact, day before yesterday, Pritesh was talking about in the institute. He was telling that they have given an emphasis of a matter, and the matter is not there in the financial statements only. What are you emphasizing? Emphasizing of a matter which is there in the financial statement, and he has emphasized. Maybe his audit working papers. I don't know what he has emphasized there without there being any matter in the financial statement. So emphasis of paragraph misused to cover misstatements like not providing interest on loan. Now, not providing interest on loan, let me tell you, some of the companies have become NPA from the bank's perspective. And the company has not provided interest because the bank has not provided interest. It is not as the bank has waived the interest. Bank has not provided the interest going in for following accounting standard 9. Collectability is an issue, therefore I am not providing and following prudential norms. I have to charge interest. If I have not charged interest, the company has not charged interest, I as an auditor will have to qualify that. That cannot be an emphasis of matter or other matters. So please note that. Auditor did not submit audit file and quality control policies of the firm called for during investigation. Violating of AS 22 by recognizing deferred tax asset of 23.55 crores, the company had huge losses without giving convincing evidence of the sufficient future taxable income. Failure to report or address errors in cash flow statement. Why I have taken up this is cash flow statement is very casual. It's actually a casual flow statement. Very casually done. We give a lot of importance to balance sheet, profit and loss account, statement of total income. Cash flow statement is a collateral which comes out, maybe the article will do it. And if he has not done it properly, finally, it's an instance. I mean, 23.55 crores in this particular context. He, without having what is an evidence that you will have future profits to create an asset? Please understand, creation of a liability is a duty. You have to create a deferred tax liability. Creation of a deferred tax asset has to be judiciously exercised and created. You cannot create an asset through a journal entry. That's the aspect. Because asset goes up, net worth goes up. ROC Patna has levied for a small child account, because he may say enough rice for big people, I am a small person. Then ROC is there to take care. Okay? What did the ROC do for a small company? Failed to make complete disclosure as per Schedule 3. Shareholding of more than 5% not disclosed. Breakup of share capital not given. Advances from relatives of directors not shown. AS 18 disclosure not shown. Auditor failed to qualify the report. Hence, ROC Patna levied penalty on the auditors at 10,000 rupees for each year and provided a discount of 50% as the company was a small company. I don't know whether this is right, because discount is for the company, not for the auditor. There is no small auditor and big auditor. Yes, sir. Very beautiful, sir. Thank you for reminding. In fact, Pritesh took up this timeline case. In 705, you can have a modified opinion. Modified opinion can be of three types: qualification, disclaimer, and adverse. Qualification we know, adverse we know, not true and not fair. Even if it is disclaimed, I am disclaiming giving an opinion whether the financial statements are true and fair. He took up this particular case and said that in that particular context, the auditor has disclaimed, yet 1 crore penalty was levied by NAFRA. The reason being, by disclaiming, you are not absolving yourself of other disclosures as an auditor which you should make. That's what you are telling, sir? Yeah. Can we have a mic? If you have, please.
Whether pervasiveness is there or not. Now these days, particularly after this NAFRA report, in case of public sector undertakings, C&AG they started a standard query and auditor's report. You are given 1 to 9 qualifications, still you are given subjective. You should have been given a disclaimer of adverse opinion. This is rampant, it is going on.
Fantastic, sir. Let me put it in a manner that all of us can understand. Our audit report, I always say, we are like matchmakers. Auditor's job is like a matchmaker, saying that the boy is fit for marriage. Okay? Now what we are telling is, we give a report saying the boy is fit for marriage. We are saying the boy is fit for marriage, except that his heart is weak, his kidneys is on dialysis, his one leg is having a problem, except for that is good for marriage. So that is what is being told qualification. So thanks, sir, for bringing it. Yeah. So I had stopped at 4 o'clock, sir, because of you. Went a couple of minutes more. So I thank you so much. And this is one of the recent pictures of my family. We went to Kaziranga, and there we saw from the elephant we could see the one-horned rhinoceros. Why I put up this picture in particular is, we started off seeing Companies Act as a patch. Both are patchy terms in that sense. We thought that Companies Act was something like an elephant, I think. But finally it proved out to be an altogether different animal. So thank you so much. I wish I could take more of your questions, unless the organizers want me to, or over the cup of coffee. Is that better? Thank you so much.
Thank you very much for a wonderful discussion. On behalf of Bangalore branch of SAICF, I thank you for the wonderful session, sir. I request CA Gururaj Proposal past chairman to present moment to the speaker. break for the tea.